In this video, I want to talk about how to turn your portfolio into a compound machine, even if you are in your 40s. The average age of my audience is in the 40s, 50s. It's not too late. And I want to make this video as a reminder and to tell you what to do so you can benefit from this stock market euphoria we have right now. You have a momentum, you have the world that is getting more and more exposure, and you have a raging bull market. So how can you benefit from this stock market that has been going up and up and up? What is your opportunity cost of not being invested? And how do you pick great opportunities so that you can beat the market? How you can outperform the market. This is what we are going to talk about in this video. In case this is your first video from this channel, welcome. My name is Christophe Noor. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. I have copied the best investors of the world, Charlie Munger, Warren Buffett, Peter Lynch, etc. And I have built my own strategy so that I can compound, and I help people do the same. I help you watching this channel achieve this 20-25% per year because I have done it. And if you are in your 40s, I want to start this video by saying it's not too late. The compound growth is a funny curve, I would say. If you look at the compounding curve, it looks like this. When you are in your 20s, 30s, you don't have a lot of capital. And then you reach 40s, you reach your maybe peak career in your 50s, and everything accelerates. The sooner you start compounding, the better, obviously. But now, if you are watching this video, you are in your 40s, 50s, you have a lot of dry powder, you have accumulated capital, and it's not too late to start. I suppose you have some stock portfolio right now. You just need a little bit of guidance to make sense of this portfolio, right? And if you make this change now, actually, when you are 40 years old, for example, and everything will accelerate from there. I'm telling you, I've seen this for many clients where it was a little bit of a mess before, and then we had a call, we worked together, and now everything makes sense. And if you have a good framework, good analysis, good stock picking, and you were not sure of your strategy before, if you implement the right strategy, you can compound at a very high level and you can finally have a portfolio that grows at your desired rate of return. It's not too late. You have plenty of time. Look at this. Look at all this growth potential that you are missing if you're not taking action right now. All this growth potential. You probably know that Warren Buffett has created 99% of his wealth after he was 50. Well, it's exactly the same situation for you. It's not too late. You have plenty of time. You have plenty of time to make mistakes, to learn, to improve, to have a strong portfolio, to pick up some great opportunities in this market. Even at an expensive market like we have today, you still have golden opportunities now. So don't say it's too late. I wanted to start this video by showing you this. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. Second point, how to clean up your current portfolio without panic. Maybe you have a stock portfolio and you're not sure of the picks you have. Maybe you are too much diversified. You have too many stocks at the same time, like 40, 50 companies at the same time. I had a call last week with somebody, exactly 40 years old. He had 100 stocks in his portfolio and he was happy to, now he only has like 80 stocks. He said, yeah, I'm pretty happy. I'm less diversified, but this is not how it works. It's impossible to follow 80 stocks at the same time. You are not a professional money manager. If you are watching this channel, you are a retail investor. You don't have the time to monitor 80 companies. I'm telling you, it's for sure. I'm 100% sure of this. I've seen people try. I've seen people fail. It's always the same thing. The best way to invest your money as a retail investor, if you are 40 years old, 50 years old, and you want to capitalize on your wealth like this, in a smart way, the Warren Buffett way, is to have some sort of concentration in your portfolio, to have maximum 30 stocks, I would say. So maybe you are too diversified. How do you clean it up? You can have many questions. You have to get rid of the bad companies. So let me tell you about the 3 filters every stock must pass to stay in your portfolio: profitability, runway, and valuation. The first one, what kind of investor are you? Do you want to invest in companies that are growing a lot? Do you want to be invested in companies that are having nice margins? What is a good threshold of margins you want to be invested in? Sometimes we are talking on this channel about companies with a gross margin of 80%. Think of TPL, Lendbridge, MSCI, Visa, MasterCard, these kind of things. Sometimes you may prefer some value investing. So the profitability is not perfect, but the stock is cheap. First, you have to ask yourself this question: what kind of investor you are? You are more inclined towards cheap companies that are not growing that much, or cash cows that are growing a lot, or companies that are growing immensely without profitability. I would say if you don't know how to answer this, these are the 3 filters I would recommend. First one, only invest in companies that are profitable. Boom, it's a hard pass. Somebody, I'm thinking of the call I had last week. He had 80 companies, and inside this 80 companies portfolio, you had companies that were not unprofitable. Companies that you didn't feel were right, not inside your circle of competence. So you can just sell all the companies that are not inside your circle of competence, companies that you don't understand really well. How do you know if this is inside your circle of competence? Well, if you can explain to a child in 2 minutes what the company does, it's inside your circle of competence. If it's too difficult, if it's too complex to pitch the investment idea to a child, it's too hard for you. Boom, automatic sell. Second thing, that's the profitability. If it's not profitable, meaning net margins, free cash flow margins, if it's not profitable, boom, it's a hard pass. And now you are washing away all the bad companies that will likely fail. Most of the times, profitable companies stay profitable. Most of the times, unprofitable companies stay unprofitable. I am aware that you have turnaround plays. Don't comment below that you have a profitable play like Spotify, Uber, things that have become profitable over time. On average, unprofitable companies fail. They have a lot of debt, you have a lot of failures, and for you, a retail investor, you don't have the time to expect a turnaround. Why don't you only pick winners? It's so easier. It's so much easier, so much simple to just pick winners and invest in companies that have been winning and winning and winning. Much more simple. So first criteria, that's the profitability. I can add another criteria with understanding of the business model, but you get my point. The second filter is the runway. What is the total addressable market of this company? How many more clients can they get? Is it a market that is totally saturated? Does the company have pricing power? How high can the prices be? These are the kind of questions you have to ask. And if you don't know these questions, maybe it's not inside your circle of competence. Maybe you have not done the work. Okay? So we are discussing this inside my coaching program. How can you ask the right questions to know how to pick winning stocks? The runway, the potential, the international markets exposure, for example. You have Costco, they want to tap into new markets now. Fair enough. You have AutoZone, the auto parts company. They want to tap into Mexico, into Brazil. Okay. Is it working? Is it not working? What's the runway? What's the total addressable market? How many stores can you open every year actually? And they are opening hundreds and hundreds of stores. So it seems to work. Okay, so runway is very important. If you are invested in a company with limited runway, with a lot of saturation in a saturated market, that's a good sign for you to sell, I would say. Now, you don't want to invest in companies that are already in a saturated market because the growth will not be here. And the third one is valuation. I would say you can buy companies and hold companies with a price to free cash flow of 30, 40 maximum. If you have stocks in your portfolio right now with a very expensive valuation, you know it's stressful, you know it's too high a price, and you are just being greedy because you hold. But on average, you have reversion to the mean for the valuation. On average, eventually, it will come down. So my recommendation is to focus on valuation, to not overpay to buy something, okay? And if the valuation gets expensive for a company you already own, maybe trimming is a good idea. But of course, you want to avoid companies that are not profitable with the EV to EBITDA. You don't want to talk about EBITDA at all. Adjusted numbers. If you adjust the numbers, it means you're lying. Adjusting the numbers, adjusting for EBITDA, it's a pure lie, actually. You are lying to yourself, and this is the reason you are underperforming. Not particularly you watching this video, but I see a lot of people making this mistake. You just adjust all the numbers to make sense of an idea, to convince yourself it's a buy. But it's already too hard. I mean, if you have to adjust all the numbers, it means it's too difficult for you, right? So, circle of competence, profitability, runway, valuation. Boom. Normally, it should erase a lot of your stocks in your portfolio. So you can have an efficient portfolio, a group of winning companies that will outperform the market. And now I want to say how you can track your performance like a fund manager. Similarly, I had a call this week with the client, 56 years old, and I asked him what I would say, John. Okay, John, what has been your performance for the past 5 years? He had no clue, no idea. I mean, so he shared his screen, okay, showed me his portfolio, over diversified as always, and he had no clue of the performance. If you don't track your performance and your CAGR, your compound annual growth rate, how do you know if you are doing a good job? How do you know if you are beating the market, outperforming the market, or underperforming the market? How do you know this? You need a huge Excel file maybe, or you need the performance to be shown in your brokerage account. You need to track your performance. If you don't track your performance, maybe you are not doing a good job and you don't know it, which is very bad actually. That's very bad to not track your performance, because you can be struggling for 1 year, 2 years, 3 years. You think you are mediocre, but actually you are very bad and you don't know it. So you are literally burning cash. You have dry powder, you have capital, you have the brains, but you don't know what you don't know. Okay, so please first track your performance. Second thing, what is your benchmark? This is what I asked before. What is your investing style? Do you want to play safe? Do you want to play aggressive? How old are you? Do you have children? Do you need to buy a house soon? Do you go into retirement? Do you have, all the questions of life that will come to you will impact your investing style. I'm in my 20s, so obviously I will take more risks than somebody who is 70. So 70 years old. That means my benchmark is a little bit aggressive. I benchmark my performance versus the S&P 500. And people pay me because I beat the S&P 500. If I didn't outperform the market, people will not come to me. Okay? I am a public investor on eToro. I have more than 4,000 people following my strategy, and they copy me. They copy my portfolio and my performance because I beat the market. Okay, so for me, it's my job. So it's mandatory to beat the market. For you, maybe not. Maybe you want to play safe. You want 6, 7, 8% per year. But in case we have a crash, you are safe. I have a client like this. So it depends. What is your benchmark? Ask these questions. If you don't ask these questions, you don't have a plan. And if you don't have the plan, this is the reason why you are wasting your time. Same thing, I talked about the benchmark, but you can also talk about the risk. What is the amount of risk you want? Risk reward, right? If you want to favor high risk, high reward, like tech-oriented companies that are growing a lot, or do you want low risk, low reward? In my portfolio, I have a company called Gravity. They are trading at net cash. So they have as much cash as their market cap, which means that they can never go bankrupt. Very low risk, very low reward, but very low risk. So it depends on you. How stressful do you want to be? Are you an anxious person? Do you have a lot of anxiety? Do you look at the markets all the time? It depends on your personality, actually. And this is also what we work on inside my coaching program. We have many profiles, people that have a lot of anxiety, people that are more relaxed. And my job is to help them make the best financial decisions for their portfolio. So it's a personalized coaching program. Okay, do I have something else for you? Have a personal investing system. Why you need one? Or you are blind. Yeah, all these points that I've talked about today depend on you. You have to select your criteria. You have to select your risk appetite. You have to know yourself. And if you don't have a personal investing system, you are running blind. If you don't know your performance, you are blind. How can you compare yourself? How can you know if you are doing a good job if you don't track everything? Imagine this was your job. I guess you are more disciplined with your job. I guess you are, this is a channel for serious people. So I guess you are reliable. I guess you are on time. These kind of human attributes for disciplined investors. So for your job, for your life, I'm guessing you have a plan what to do with your life. For investing, it's the same. You need a plan. You need a plan or you will just waste hours and hours and hours of your precious time. The goal is to focus, have a framework, know what you're doing, only pick winning stocks and outperform the market. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.